All right, let's dive right into this. Welcome to The Explainer. Today we're unpacking what has to be one of the most wild financial paradoxes in recent aviation history. In the June quarter of 2026, Delta Airlines basically looked at gravity and told it to take a hike. We're going to unpack their latest earnings report and see exactly how a legacy carrier fundamentally re-engineered its entire business model to pull this off.
So here's our flight plan for today. First, we'll look at the paradox, then the power of premium, the loyalty ecosystem, running the machine, and finally, the flight path. Let's get to it.
Section 1. The paradox.
To really grasp what Delta pulled off here, we've got to look at the sheer scale of the headwinds they were flying into. Get this. Delta generated a massive $1.4 billion in adjusted pre-tax profit in the June quarter, and their total operating revenue, it actually hit a record $17.7 billion. Now, in a vacuum, those numbers are absolutely incredible, but they really don't tell the whole story until you look at the other side of the ledger.
Because here's the crazy part. Delta achieved those record profits while simultaneously taking on the highest quarterly fuel expense in the company's entire history. Adjusted fuel prices surged 75% year over year, hitting $3.93 a gallon. That brought their total adjusted fuel expense to $4.4 billion. Historically speaking, a cost spike like that is usually an extinction-level event for airline profitability.
So that brings us to the central mystery we're solving today. How on earth do you make record profits when your most volatile, completely uncontrollable cost just goes through the roof? Well, the answer comes down to fundamentally changing what an airline actually sells.
Which brings us to Section 2, the power of premium. To solve this giant fuel cost puzzle, Delta completely flipped its revenue streams. They moved away from the highly price-sensitive standard economy passenger. Look at this. Diverse revenue streams and premium products now make up 61% of Delta's total adjusted operating revenue. Main cabin revenue is just 39%. Delta basically built a fortress around its bottom line by ditching the reliance on basic, commoditized airfare. And a massive driver of that 61% majority? Premium seating. Premium revenue actually grew an impressive 17% year over year. And you know this isn't by accident, it's the payoff from aggressive, sustained investments in cabins like Delta One, Delta Comfort, and Premium Select. They even saw a massive 25% jump in premium corporate sales. The takeaway here is simple. People are absolutely willing to pay for comfort, and Delta positioned themselves perfectly to capture that.
Delta's CEO, Ed Bastian, really hit the nail on the head in the earnings release. He said they're executing from a position of strength, reflecting momentum across their diversified revenue base. That right there, diversified revenue base, that's the magic shield against almost $4 jet fuel. When you aren't just stuck in this race to the bottom to sell the absolute cheapest ticket, you actually have the pricing power to absorb those huge macroeconomic shocks.
All right, Section 3, loyalty and the ecosystem.
Now, selling better seats is great, but it's really only part of the equation. To truly understand Delta's durability, we have to look outside the airplane altogether. Loyalty and related revenue grew 19% in Q2. That means SkyMiles member engagement is expanding way beyond just air travel. Delta is monetizing its relationship with customers every single day, not just on the days they actually head to the airport.
And a hugely crucial piece of that puzzle is this number, $2.4 billion. That's the payout Delta got from American Express in just one single quarter. It's a 16% jump over last year, driven by accelerating card acquisitions and, get this, the 7th consecutive quarter of double-digit year-over-year growth in cardholder spend. This Amex co-brand portfolio is literally a cash machine, and it operates completely independently of whatever jet fuel costs on any given day.
Plus, Delta is actively making this ecosystem even stickier. They've leveled up their T-Mobile partnership, offering premium drinks on board for linked members. They re-upped a massive, decade-long partnership with Airbnb, so SkyMiles members can earn points on stays. And they're expanding their Delta Sync onboard partnerships with brands like the Wall Street Journal and Fox One. It creates this closed-loop ecosystem where consumers are essentially living inside the Delta brand. It makes them highly profitable before they even step foot on the jetway.
Moving on to Section 4, running the machine.
Of course, premium pricing and credit card swipes aren't going to save you if the actual flying experience is terrible, right? You got to run a premium operation. And Delta delivered. They led all carriers in on-time arrivals and departures for the quarter. In Atlanta, they rolled out this proprietary baggage AI technology, which improved their mishandled baggage rate there by 50% in June alone.
Add in the fact that over 95% of their fleet now has fast, free Wi-Fi for SkyMiles members, and it's no wonder they were just named the #1 U.S. airline for the 8th year in a row by the Points Guy. That operational excellence is exactly what keeps that 61% premium revenue flowing.
But let's be real, running a top-tier airline is expensive. CFO Eric Snell pointed out that as capacity growth starts to normalize in the second half of the year, they are laser-focused on efficiency. They're targeting low single-digit non-fuel unit cost growth. By keeping the rest of the business incredibly disciplined, they can protect those profit margins even when energy markets go completely wild.
Which brings us to Section 5, the flight path.
So what do these gravity-defying Q2 results actually mean for the immediate future? Well, Delta is expecting this aggressive momentum to just keep going. For Q3, they're guiding for total revenue to be up in the mid-teens year over year. They're projecting a highly profitable operating margin between 11% and 13%, and earnings per share between $2 and $2.50. Basically, they're expecting this strength to ride right into the back half of the year.
And as for the full year 2026, they are confidently reaffirming their initial guidance. We're talking an expected adjusted EPS of $6.50 to $7.50, and a massive free cash flow of $3 to $4 billion. Like Ed Bastian noted, they are completely on track to grow earnings by 20% for the year. And remember, they're doing this while successfully fighting off what is literally a multi-billion-dollar fuel headwind. It's just a stunning display of financial durability.
Finally, Section 6, Conclusion.
So we've seen the paradox, their massive pivot to premium, the sheer power of that Amex ecosystem, and the operational rigor that holds the whole thing together. Delta absorbed a massive 75% fuel price shock and still posted a $1.4 billion profit, all because they fundamentally changed their identity. They aren't just an airline anymore. They're a premium lifestyle brand that just happens to fly airplanes. So I'll leave you with this. If a mega airline is now making 61% of its money outside of standard economy tickets, what does the future of the broader aviation industry really look like? It kind of seems like the days of surviving purely on cheap fares might be grounded for good. Thanks for joining me on this explainer. Keep learning, and I'll catch you next time.